Okay, let's do another video update. It's Thursday morning, August 22nd. We'll start with the dollar. As you can see, the dollar is having a hard time as of late. It started in early August with the jobs report, and then the yen carry trade began to unwind. The dollar was in a free fall. During that time, retail investors were selling the dollar. They tend to follow price, so as price was moving lower, they were selling. And smart money was on the other side of that trade. They were buying as the dollar was moving lower in this 102, 103 region. But this past week, the dollars continue to melt down, even though the economic data has been relatively stable. Jobless claims were lower than expected last week. Retail sales was pretty strong. But nonetheless, the dollar is selling off. So if retail tends to sell when the dollar falls, it's reasonable to believe that they've been selling this week, which likely means that smart money is buying again. And so we would then have the smart money doubling and tripling down on their bullishness in the dollar, which suggests that a dollar bounce could be near. And as you can see, if yesterday's low was the interim low, the dollar will have made a higher low relative to its low in December, which was a higher low relative to its low back in July or August of 2023. Now, if we look at relative sentiment in some other currencies, we see that the smart money is buying the dollar and the yen, and they're selling the euro and the pound. Now, when they sell the euro and the pound, that tends not to be great for equities. And equities have been in a very strong rally since August 5th. The S&P is pretty much near its all-time high again in just 13 days. So that entire move was essentially retraced. But it's been so one way and so extreme, and the smart money is selling the euro and the pound, so we might see a pullback in equities in the near term, just given how extreme the bounce has been. Also, whenever the smart money is buying the yen and the dollar, that tends not to be so great for equities. It tends to suggest that financial conditions might be getting tighter. So, given the fact that they're buying the dollar and the yen, selling the euro and the pound, it could mean that a dollar bounce is in the offing. If we look at the euro long-term chart, it's a weekly chart, you can see that the euro is in a long-term downtrend, and it's also right by its 200-week moving average. So, given that these are important technical levels, we would expect that at least there would be a temporary pause when the euro gets to that downtrend line, or even potentially here at the 200-week moving average. So that's another reason why the dollar might bounce in the near term. Now, the dollar move has been very beneficial for gold and for precious metals in general. Composite relative sentiment in gold turned bearish at 2350. Gold has gone up another 8% since then. That leaves it 14% above its 200-day moving average. Back in April, it was 18% above its 200-day moving average, and as you can see, it kind of chopped around and went sideways as the 200-day moving average started to catch up. Again, we're somewhat divergent from that 200-day moving average. 14% is a pretty large gap. It's also in a rising wedge, and if it was a beneficiary of the dollar moving lower, if the dollar bounces, we could very well see gold fall out of this rising wedge and potentially start moving back towards its 200-day moving average. Silver is a somewhat similar. It's not in a rising wedge per se, but it could be forming a head and shoulders pattern. It's right back at the level it was whenever composite gold relative sentiment turned bearish. So I think caution is warranted in precious metals. Smart money's buying the dollar dip. Gold is way above its 200-day moving average and in a rising wedge. Silver looks like it could be a potential head and shoulders. And if we look at the spot composite gold relative sentiment, it's getting more bearish. So that's this gold line here. The blue line is a smooth version of this gold line. The gold line, as you can see, is moving lower, so it's getting more bearish. So that could also contribute to a reason to be cautious on precious metals. Now, if you read the newsletter, you know how I feel about gold over the long term. I think it's going to be one of, if not the best performing asset in this secular cycle. So the fact that it's being quite resilient here whenever the positioning landscape is negative for it, it really highlights the fact that this secular cycle is essentially made for gold. Gold is in harmony with the secular cycle. So in the last time positioning was bearish for quite a while, gold went sideways, so it really didn't pull back. And then here, positioning was bearish, and it went up again. So gold is essentially telling us that it is the asset for this secular cycle. Nonetheless, if the dollar does bounce, I would expect gold to at least at best go sideways, and at worst possibly pull back towards its 200-day moving average. Now let's look at rates. This is TLT. So Yellen's quite happy. Rates have moved lower. That's exactly what the U.S. fiscal situation needs. Now, is it sustainable? Well, if we have a recession, rates are likely going to move higher, because a recession would mean that unemployment would rise, so income tax receipts would go down, and equities would likely go down, which means capital gains tax receipts would be reduced, and spending probably isn't going to go down. If anything, they might increase spending as a stimulus. So deficits will explode, and our deficit is already 7% of GDP. So in a recession, it could go to 12, 15, maybe even 20% of GDP, in which case Treasury supply would be enormous. So that would put upward pressure on rates. Now, if we don't have a recession and growth remains, resilient and robust, then because we're in an inflationary secular cycle, inflation is going to reemerge at some time, whether that's later this year, early next year. At some point, inflation will start rising again, and that would mean that there would be upward pressure on rates. So it's hard to see how rates can sustain at these levels, and the 30-year yield below 4% would seem completely unwarranted, given that over the long term, inflation is likely going to be much higher than 3%. So the real return on long-term treasuries would be zero or negative. So it seems like there could be a catastrophe in the making here if rates fall too far, because eventually they're going to have to rise pretty sharply. And if we look at the spot positioning in TLT, excuse me, it's back to its worst level in the last 2 years. So composite relative sentiment for long duration bonds is quite bearish. They've rallied, even though it's been bearish the last several weeks. But with rates where they are, and recent bond auctions being pretty bad, can rates sustain these levels? We'll have to see. I think over the long term, certainly not. Short term, maybe the rally can last a few more weeks, a few more months, but eventually rates will have to go higher. Now, if we look at oil not looking too good itself. Could be in a descending triangle here. What's interesting is that oil, if you look at the crude inventory draw, 7 of the last 8 weeks, we've had a bigger than expected inventory draw. Yet, crude oil has essentially been going down that entire time. It hasn't been able to move higher. Now, oil below 70 starts to make U.S. production not economic, in which case, oil will probably bounce around those levels. But if we're headed for a recession, potentially things could get worse, and maybe it does break below this lower boundary of this ascending triangle. Nonetheless, we're in an inflationary secular cycle. Commodities will be in a secular bull market throughout this cycle. And as you can see, the secular bear market low was here back in April of 2020 when crude oil went negative. It's been up ever since. It's kind of consolidating because it had a huge up move in 2021 and into 2022 with the Russia invasion of Ukraine. It's been pulling back, but eventually it will embark on another leg higher. So if it continues to move lower here, that could be a good entry point for a commodities ETF, which will likely perform quite well over the next decade. Now, let me jump here to XLE while we're talking about oil. XLE has been holding up quite well given what oil's been doing. So XLE is up on the year, even though oil is near, in the low 70s right now. So I think that also highlights, like gold, that XLE will be one of the stronger performing assets over the next decade as we move deeper into this secular bear market driven by high inflation. The fact that it's holding up well here, even though oil isn't holding up well, does suggest that XLE will be one of the outperformers over the next decade. So now let's look at the S&P 500. this chart is kind of ridiculous. So we sold off with the yen carry trade unwind, and also the jobs report caused people to think that a recession was on the horizon. So we bottomed on August 5th, and we've been up essentially the next 13 days. We only really had one down day of note. It was 2 days after August 5th. It was a Wednesday. But since that point, the market's been straight up. It had a couple red candles, but they were kind of negligible. So the market's a little bit overbought here. It's right back up to the highs. It's right back up to this technical level, this Fibonacci technical level that kind of halted the advance the first time. We'll see if we can get through this time. So some catalysts coming up. We have Jerome Powell's Jackson Hole speech tomorrow. Now, if he's not as dovish as people expect, the dollar probably bounces, equities probably pull back, especially after this extreme rally that equities have had. Another catalyst on the horizon is NVIDIA earnings next week on Wednesday after the close. That will be interesting. We'll talk about NVIDIA in a second. And then the August jobs report in early September. That will also likely have an effect on equities, given what the last jobs report did and what people might be expecting with this one. Now, some bullish factors. We're in the home stretch to the election. We've got September, October, and then a week in November. So about 9 or 10 weeks until the election. I would be surprised if equities fell below this recent low before the election. I think at worst it will, maybe pull back, but generally stabilize. I doubt the equity market will be in a free fall come the election. And we could be in a potential blow off top, which I think would be fitting given the bubble that we're in. We had the dot-com bubble, we had the everything bubble in 2021. Now we're in this AI bubble. So a potential blow off top would seem natural for the environment that we're in. On the bearish side, composite equity relative sentiment has turned neutral from being strongly bullish. Now that's not necessarily bearish, but it's not strongly bullish anymore either. So when it's neutral, the market tends to have below average equity returns, though slightly positive. We've had this straight line rebound. We probably need some type of pullback. Given that straight line rebound, you can see we have this gap here a few days ago. The S&P probably will eventually close that gap, but it might do that sooner rather than later. As we talked about, a dollar bounce is likely. We also have this asymmetry where if NVIDIA misses its earnings, there's likely much more downside potential for the market than upside potential if NVIDIA beats. And as the market's rebounded, valuations are again approaching the worst levels of all time. And over the longer term, valuations matter. And so that would make the future returns even worse. So eventually those will start to weigh on the market. Here is the ratio of QQQ, the NASDAQ 100, to IWM, the Russell 2000, small caps. And it's really been binary since mid-May. So since starting in mid-May, we had this 2-month stretch into mid-July where virtually every day the NASDAQ was outperforming the Russell 2000. Then we got the CPI report in July. On July 11th, it was cooler than expected. Everyone realized, okay, the Fed will be lowering rates. And then we had a 3-week period where the Russell 2000 just outperformed the NASDAQ every day. Then, starting on July 30th, it's reversed again. Now the NASDAQ is outperforming Russell 2000 every day. And my impression is that this type of binary behavior, it's not quite stable, it's not healthy, it's not sustainable. So I think that suggests that the market is somewhat fragile. I mean, this sell-off here from July 11th to July 30th was just violent. And that doesn't seem like it's, the hallmark of a stable market. So, whenever NASDAQ stops going up relative to Russell 2000, we probably get another violent pullback in that ratio. Here's NVIDIA. So it looks as though this 3 peaks in a domed house pattern that we've been tracking since late last year might be breaking. It might be starting to fail. This doesn't necessarily look like a head and shoulders anymore. Unless it kind of goes a lot higher and forms a bigger head and shoulders and then another shoulder, but that's getting a little bit too nuanced. You can see that Nancy Pelosi added to her NVIDIA position here. It fell 20%, but now it's above that level. And it has earnings next week. If they miss earnings, that could be bad. Or even if they beat on earnings, it could be a sell the news event, given how strongly it's rallied. It's up, I think, 40% since its low on August 5th. It was down around 90. Now it's up near 130. So even if earnings come in better than expected, we could see NVIDIA sell off simply because the smart money might use the liquidity from retail traders who say, oh, earnings are better than expected, let's buy. Smart money might use that to sell. I've seen several pieces come out about certain well-known investors, basically sold all of their NVIDIA by the end of the second quarter, before the market sold off in mid-July. So that also might be somewhat of a foreshadowing of what might happen with NVIDIA after earnings, unless they bought back in August, whenever the market was selling off. If they have stayed out, that might be an indication that the smart money thinks that the AI rally might be on its last legs. So we'll have to see how that plays out. But even if they beat, it could be a sell the news event. If they miss, I think that would be quite bad for an NVIDIA. I think it would be quite bad for the NASDAQ 100 and by extension the S&P 500. Now, if we look at Meta, I find this pattern quite fascinating. It's been in this megaphone pattern dating back to 2018, and it's basically tried to break out of this megaphone on 3 separate occasions in the last, call it a year. So here, and here, and it got rejected pretty strongly each time, but it immediately bounced back, and we're right back at the top of that megaphone. Now, will it fail a 4th time, or will the 4th time be a charm and it will break out? Now, if it does break out, I would think that would mean that we are in the blow off top stages. If it breaks out, that likely means NVIDIA is going much higher, which likely means that the NASDAQ 100 is going much higher, and by extension the S&P 500, and so we're probably at the blow off top stage if this breaks higher through this megaphone pattern. And something similar with Apple, so it's in this longer term bull flag, which would project to 251.79. A few weeks ago at this peak here, it was only 6% away from 251.79. It's making its way back up to that level. If it eventually does reach 251.79 in the next several weeks, several months, again, we're probably in the blow off top stage. So that's really all I have. I would expect, so we could be in the blow off top stage, in which case, look for the market to go higher, but it's not going to sustain those levels. Blow off tops are followed by crashes. But if we don't have that blow off top, given the extreme rebound from August 5th, I would expect the market to pull back in the near term, especially given the likelihood that the dollar bounces. And so, dollar bounces, equities pull back, precious metals likely pull back. So that's sort of my expectations in the near term. Let's see what Powell has to say tomorrow and see how investors have changed their positioning this past week, which we'll talk about in the weekly newsletter, and we'll go from there. Thanks for watching.